Okay, so those are just a few of them. There are actually 163 different ways to reduce your EFC. So those are just a few of them. There's a number of different options. It's kind of like tax planning and reducing your taxes. There are a number of variables involved. Now, the colleges and the government do not want you to know that you can even lower your EFC, because once again, that means that they have to pay more out of their pocket. And our goal is to maximize the amount of free money. That's why, like I said, I'm sharing with you the secrets that I have learned, in how to reduce the cost of college. Now, every family will have a different EFC each base year. Okay, so what are the base years? Well, the first base year is going to be when your kid is a high school sophomore through high school junior. So that tax year. So the spring, of the high school sophomore year and the fall of the high school junior year. That's the first base year from the tax year standpoint. The second base year would be the tax year when they are a junior and a senior. The third base year would be the tax year when they're a senior and a freshman in college, and then freshman in college to the college sophomore is the fourth base year. Now, this is for calculating only the income portion of your EFC, not the assets, okay? So the income is going to be based on those base years. The assets are going to be based on the day that you fill out the financial aid forms. So yes, that is correct. If you could get rid of some of your assets the day before you fill out the financial aid forms, then that can still lower your EFC. So for those of you who have seniors in high school or even freshmen in college, because since you have to fill these forms out every year and your EFC changes every year, this is why you can still reduce your EFC and still get additional, free money, even as late as a senior and freshman in college or so. Now, the earlier you get started in planning all of this, then the lower you could get your EFC. That's why I say it's never too young to start applying some of this information. Okay, so if we lower our EFC, then that means that we have a larger need or financial aid eligibility from a need standpoint. Now, for those of you who have a really high EFC and you can't lower your EFC, that doesn't mean that you still don't qualify for financial aid. It's just not going to be the need-based financial aid. It'll be merit-based financial aid that we'll talk about in just a little bit. So let's take a look at what I mean by this. So let's go back over here to our sample with these 5 schools. And so once again, we have these 5 schools. What I have highlighted here is the cost of attendance for these 5 schools. And so like I just talked about, what we are going to do is we are going to take that cost of attendance minus the expected family contribution for this family. Now, do you notice how some of the numbers are different? We've got a $36,000 EFC and a $38,000 EFC. That's because some of these schools are using the federal methodology and some of these schools are using the institutional methodology. That is extremely important to know, because if you're looking at schools that are using the federal methodology, then you don't have to worry about the equity in your home and your business assets. If you're looking at schools that are using the institutional methodology, then you have to worry about those assets and how that's going to affect your EFC number. But either way, we take the cost of attendance minus the EFC number, and that equals what we call the need, or the financial aid eligibility in the form of a need. So as you can see, since Texas is so cheap, it's actually lower than our EFC, so we don't have a need. But Wesleyan at $80,000 a year, you subtract that from our EFC of $38,000 and we have a financial need of $42,000. Okay, so here is a summary of what I've been talking about. If you are right here where the X is, okay, your goal is to lower your EFC as low as you can possibly get it through some of these financial strategies that I just talked about, and then encourage your students to be as exceptionally gifted as possible. In other words, increasing their ACT scores, getting good grades, things like that, because the whole goal is to get down here into this left corner here, where we have an exceptionally gifted student and a really low EFC. Now, let's just say that you have a low, or let's just say that you have an exceptionally gifted student, but you have a high EFC. That's okay. You are still going to get some discounts and some free money. It's just not going to be in the form of need-based aid. Now, let's say that you have a really low EFC and you have an average or poor student. Well, then you may or may not even get accepted, okay, to the schools. Now, if you have a really high EFC and you have an average or poor student, well, then that's when you're going to be paying full price for college. Just as kind of a summary of what we have talked about so far. Okay, so let's take a look at a couple of case studies. Here is a family, and these are all real families, of course, real clients, where the family income in this scenario was about $55,000 a year. They had about $23,000 in UGMA money, 5 family members, 1 in college. The initial EFC was $16,000 a year. The final EFC was $4,000 a year, and they received $42,000 in financial aid at the University of San Diego. All right, case study number 2, family income on the opposite end of the scale at $467,000 in income, $360,000 in taxable investments, $250,000 in home equity, 4 family members, 2 in college. The initial EFC was $78,000. The final EFC was $11,000, received over $21,000, almost $22,000 in financial aid at Baylor. Okay, case study number 3, family income of approximately $110,000, so kind of in the middle of those last 2. No home equity and $160,000 in a 401k. 5 family members, 1 in college. The initial EFC was approximately $42,000. The final EFC, $21,000. Received $23,000 in financial aid at the University of the Pacific. So, as you can see, 2 families side by side. Family A on the left, family B on the right. Both with the same income, both with the same college savings, both with the same, other savings outside of college savings plans, both with the same amount of real estate or equity in their home, both with the same number of family members, and both with the same number of kids in the school, and a $10,000 a year difference on the EFC. Now, depending on the school that you're choosing, that could be an additional $10,000 a year in financial aid. In other words, that could be an additional $40,000 off the cost of college, simply by knowing how to lower your EFC. So it doesn't really matter, whether you have a low income scenario, high income scenario, not a lot of assets, a lot of assets, doesn't really matter. You never truly know what your EFC is going to be, and you never truly know how low it can actually go until you look at all the possible strategies. So keep that in mind. You definitely want to be able to lower that EFC as low as you possibly can when possible.